Hi, it's Mr. Mortgage here. End of April, we're getting ready to go into the summer home buying and selling season, depending on which side of the fence you're on. And many of you out there are going, hey, it might be a good time to buy. Home values are way down in comparison to where they were, but just because they're down from where they were, it doesn't mean they're affordable. So what I'm going to do is address what I like to look at in determining whether or not a house may be a good buy. I get a lot of email and a lot of calls regarding that. And I want to share that with you because I think it's real important. Remember, the home is the biggest investment you'll ever make, and it's your biggest expense as well. And there's a lot of wild cards out there that could just crush you if you're not prepared. So let's go over those. But first, I want to thank the millions of people that have joined me on my new blog at my new home at ML Implode. That's the Mortgage Lender Implodometer. If you go onto the homepage, you'll see my head in a big yellow star, or my big head in a yellow star, depending on how you want to look at it. Click that. That'll take you to my blog. We're having fun. We're building a vibrant community together. We want you to be there. As a matter of fact, enter your email address up on top and you can get the updates at the end of every day instead of having to go on every day. But we'd like to have you there real time, of course. So, housing is down considerably in all states over where it was a couple years ago. But is it affordable? I mean, what makes a good housing market? What makes housing affordable? Interest rates, perhaps jobs, the broader economy. As interest rates drop, people can buy more home. As more people have jobs, more people can buy homes. As the broader economy is humming along, more people are willing to speculate, perhaps on second vacation homes and investment properties. And all those things make for a good housing market, affordability. And right now, all those things, of course, are going against us. People like to say rates are historically low. Maybe they are compared to the 70s. I don't care about that. I care about what's happened in the last several years. For example, at the end of 2004, when a 10-year note, which we like to use as a proxy for mortgage bonds and rates because they're similar durations, was at 4%. At the end of 2004, a 30-year fixed conforming Fannie Mae Freddie Mac loan was 5 1/4 at 0 points. Today, that same loan is 6 1/4 at 0 points. A 30-year jumbo was 5 1/2 to 5 3/4. Today, it is 7. It's 8% for bank portfolio product, 7% at no points for Fannie Mae Freddie Mac, the new conforming jumbo products they have. As a matter of fact, a 5-year interest-only jumbo loan, which is now considered exotic, was 4 1/4 to 4.5%, 25 to 50 basis points over U.S. Treasuries. What were you investment banks thinking? 25 basis point spread over U.S. Treasuries. Those are supposed to be the safest investment. So, you know, things were priced a little bit too low, needless to say. Now, things are pricing in risk appropriately. You know, we have risk inherent with mortgage loans. Things happen. Mortgage loans go bad. Now we're seeing all the bad effects of it. Negative equity, leading contributor of loan default, and so forth. So perhaps now they're pricing things right, and perhaps that's why some of these mortgage bonds Fannie and Freddie put out, which are supposed to be AAA, are trading at 90 to 92 cents on the dollar. Maybe the market's finally getting it right for a change. Remember, price is the best risk mitigator, and perhaps they're finally pricing things how they should have been priced all along, but that's for a different topic. Between 2002 and 2007, affordability surged. We had lower interest rates, as we just discussed, stated income, no doc, no ratio loans, second mortgages to do away with down payment, higher debt to income ratios. These things are all gone overnight. We're a 30-year fixed payment rate society now with a down payment. We haven't seen this. Well, we saw this for decades leading up to the turn of the century, but now we don't have any exotics anymore. So everything has changed. That same piece of property isn't necessarily as affordable or more affordable because the price dropped. We got to see what happened in the past, learn from that, and figure out how to value these properties going forward. I'm going to tell you what I like to look at and what I always like to look at. Even during the bubble years, I like to look at this. First of all is I like to look at median incomes versus median home prices in a small city. The city I'm looking at, don't look at big geographic regions, look at the city. You can find this on the city's website in most cases. So, that is so you can determine whether the median person in that city can buy the median home. Over time, they can, but now they sure can't in most places in the state of California still. As a matter of fact, I will look at a large geographic region here, Northern California. In Northern California, the median household income is about $71,000. The median home price is over $700,000. $71,000 under new program guidelines and rates only buys you about a $300,000 mortgage. 20% down, about a $375,000 house. We're still over $700,000. That means the median person in the Bay Area cannot buy the median home. That's not a good sign. That means everyone has to put 50% down, get a massive raise, or values have to drop. Which is it? Values dropping is the easiest. Second thing I like to look at is, can I rent the home for my mortgage indicator? Real simple. If I had to leave tomorrow, can a renter pick up the mortgage payments? Third is the cap rate, or return on investment capital. You take all of your mortgage payments, all of your rents rather, throughout the year, subtract expenses, which are taxes and insurance and all the other expenses, divided by the home price, and you come up with a number similar to a return on investment in stocks and bonds. And in commercial real estate and investment property buyers like to use that. That's a little bit more sophisticated. Lastly, and most importantly, I think right now in this market is a wild card we've never seen before. I like looking at the foreclosure action around a property. Remember, within a 1 mile radius of any given property, that determines your value. Sales, comparable sales within that radius. So if you buy a property today at $450,000, within 6 months, 3 go off at $350,000. Your property's magically worth $350,000, and that's what's happening. This REO inventory, which just happened to be, which is real estate owned by banks, foreclosure inventory, just happened to be 38.4% of all existing home sales in the month of March in the state of California. This inventory is being sold at 20 to 50% off. If you go out there and buy a home today, happen to buy a home in a neighborhood, there's a lot of foreclosure activity. Foreclosures aren't selling at auction. Remember, only 2.5% sold last month at auction, so most of it is going back to the banks. You're setting yourself up to get slaughtered. 95% of real estate sales professionals do not tell you about this hidden risk. It's horrible. It's out there everywhere. You need to be made aware of it, because this is what will really get you. Foreclosure and real estate owned by bank risk. I'll show you how right now you can look at that, or you can force your real estate sales professional to give you that information. Because if they don't give it to you, they're really not doing you a service, and they're not protecting themselves. They're setting themselves up for liability, and they're setting you up for a fall. Be right back at you. Hi, we're here on foreclosureradar.com now. You can get there through my site. I have a link up there all the time, plus it'll be on this report. I'm going to do a search of an actual listing in Pleasant Hill, California, a bedroom community. I'm searching all of the foreclosure activity within a 1 mile radius, because that's what's going to influence the property. Look at that. 60 results within a 1 mile radius. The greens are notices of default, which are 90-day lates. The blues are foreclosure auctions, and the red are the dreaded bank-owned properties. Let's click on one of the bank-owned properties right here. Nadine Court. Look at that. The banks only owed $367,000, but the sales price of the home we searched for was $477,000. If the bank discounts that to what they're owed, which is $367,000, which they'd be a fool not to make a quick sale, you just lost $110,000. This, in my opinion, is the biggest risk to real estate out there. These notice of default foreclosures and bank-owned properties. This is what will come back and get you. This is what's selling. As a matter of fact, 38.4% of all existing homes sold last month in the state of California were these properties. That's some pretty scary stuff, guys. Inventory outside the MLS that people have very little incentive to tell you about, that can come back on and whack the value of your home if something sells within a 1 mile radius that's similar to your property. Remember, these things are going for 20 to 50% discount. It's very important you know the facts, and now you know where to find this information at foreclosureradar.com. People try to tell me all the time the buyer sets the price. This is a new dynamic in real estate. This is a risk many people don't know about, and no one has incentive to tell you. Now you know about it. Also, you got to look at past comps. But what happened in the past doesn't necessarily mean it's going to happen in the future. So I still believe that it's more important to look at this foreclosure activity going on. Also, look at listings. You got to see what people are listing homes for. That's maybe your baseline. That's where you start negotiating from with what you've just been armed with. Consult a CPA and tax preparer, because there are advantages to buying real estate as a primary residence. There are some great deals out there, no doubt. But you need to know where you stand. Also, make sure you consult a real estate professional when doing these transactions unless licensed to do so yourself. If you like this video, give it 5 stars. Go to ml-implode.com to get to my new blog or for your daily and mortgage and housing news. Again, have a great day and don't believe the hype.